And good evening. Tonight, surging profits come with a dire warning from the world's largest oil company. Saudi Aramco says soaring crude prices have helped boost its net profit by 44% in the second quarter alone. But its CEO warns global inventories are running dangerously low despite measures to reroute flows. In all, the world has lost more than 2.6 billion barrels of oil since the Iran war began, equivalent to nearly a month of normal global crude production. Aramco CEO says that shortfall would take up to 18 months to replenish once the Strait of Hormuz reopens. Now, Saudi Aramco's bumper earnings report comes hours after U.S. President Trump said that oil giants are unfairly profiting from the war with Iran. Listen.
They're making too much money, okay? Based on a shortage, they're making too much money. I don't like it. And I should be the last one to say, because I'm a big free enterprise guy, nobody bigger. And, you know, you're going to see oil, when we're finished with Iran, you're going to see the prices drop through the floor. But they made too much money, too much money. Chevron, too much money. ExxonMobil, too much money. When you look at one company where they made 12 times what they made the year before, they're going to give some of that back to the public.
Helima Croft is the global head of commodities at RBC Capital Markets, and she joins us now. I can't imagine what you were thinking when you heard that from the Oval Office. And I mean, in general, even if you're not looking at one single company, right, these profits are in the here and now. It's not that, the math isn't that simple for these oil companies, right? I mean, there is huge capital expenditures, and in other times when the price is low, they carry that on their balance sheets.
No, 100%. I mean, when you have such volatile oil prices, it can be boom or bust for these companies. And President Trump has been the big champion of American energy dominance, U.S. production growth. And the reality is that there is a price that incentivizes further investment in drilling. So I do think it's going to be an interesting dance over the next couple of weeks between the White House and these key oil executives. It's also really important to understand that for retail gasoline prices, like these companies, even though their names might be on retail gasoline stations, they're independently owned. And so the question is, like, how much are they really involved in setting the price that you pay at the pump when they are not the owners of those retail gasoline stations?
Yeah, and that's such a complicated equation depending on what kind of refinery capacity there is and what type of gasoline you're buying. I do want to get to the warning from Saudi Aramco, which I found interesting. And I will say necessity here is the mother of invention. You know, Saudi Arabia has found alternate routes here, including through Egypt.
Yes.
The country is right now looking to build a military coalition to protect one of the alternate routes in the Red Sea. Are you confident that producers can avoid a supply shock? And what I mean to ask you is, look, we all know there are going to be supply constraints in the coming weeks and months. That's different from actually having a shock. I mean, but when I look at it, I think they're doing quite well, better than I would have assumed.
Well, I think Saudi Aramco really shows the benefits of investing in redundant capacity. I mean, they made the investment, years ago in the East-West pipeline. That's what's enabled Saudi Arabia to export through their port on the Red Sea. That's a big driver of Aramco profits, was they had a workaround. But they made the investment in redundant infrastructure that wasn't used at full capacity. It was sort of the rainy day infrastructure. It is being used now. The question is, if we are coming out of this war, and I still think that's a big if at this point, who's going to make the investments in other pipeline projects? How easy is it going to be to build pipelines that run, across national boundaries? I mean, Saudi Arabia is lucky because they control both coastlines. It's their own territory. So I think the big scramble post-war, if we get to that point, is going to be who pays for the new offsetting infrastructure? Because as long as Iran is operationally in charge of the Strait of Hormuz, I think there's going to be a race to try to find alternative routes.
And given all of that, I am wondering what you think will happen to energy prices over the next few months or even years. And I do want to bring China into this conversation because they've really helped avoid a real spike here. They haven't been buying oil in the quantities that many thought that they would in the last 6 months.
I mean, if you ask me what is like the big factor of why we're not at $200 oil, because this is, make no mistake, the largest physical supply disruption in history. I mean, Amin Nasser, the Aramco CEO, said 11 million barrels a day is is being disrupted. Like, that's a colossal number. But the fact that China pared back its imports by 4 to 5 million barrels a day, they became the swing consumer, and they played a very big role in balancing the market. And the question is, does China come back as a buyer? We're seeing minor green shoots, from some of the refineries in China in terms of expanded utilization rates, but that's a big question mark. When you talk about where prices are going, what's China's appetite at this price point to come back in as a buyer? Because we still think it's going to be very challenging to unbottleneck the Strait of Hormuz. Again, as long as Iran is in charge, that's going to be a question for shipping companies. What's your appetite to go through there? Are you willing to pay a service fee? Are you willing to risk drones and missiles still? Like, I think some of these companies are going to wait to see if this situation really stabilizes or whether it's just a temporary truce.
6 months ago, we started in on this worried about supply in so many commodities, not just oil. I'm wondering what happened to a lot of that anxiety. Is it still out there? I'm thinking about things like helium, fertilizer, jet fuel, all the commodities there. What do you believe is going to happen with those other things that are so reliant on the Strait?
These are such great questions. I mean, we're watching what happens with natural gas very closely because Qatar is the largest LNG, liquefied natural gas exporter. They've been essentially blocked in. They don't have an alternative route to Hormuz. And so the question is, how quickly could we get Qatari cargoes moving? Because Europe right now is behind where it should be in terms of building gas storage going into winter. And while Qatari LNG primarily supplies Asia, there's a question, if we don't get Qatar LNG back up in sufficient volumes, are you going to have a bidding war for the available U.S. LNG cargoes? The U.S. has really ridden to the rescue once again of Europe with its oil and gas exports. If Qatar LNG remains off the market, there'll be competition for those cargoes come winter.
Yeah, it will be interesting to see how that plays out. Again, as you said, that is a market that you can't easily have the redundancy that you might have in oil markets. Helima, so good to see you and good to have you on a program. As I said,
thank you for having me.
Such a historic day to have you on. Appreciate it.
Thank you.